Hello and welcome to Options Guide TV. We are, I don't know, I guess the markets are a little choppy. They want to go higher. What's the feeling in AI once again? How are some of these companies doing as far as who's in the lead and who's going to win the battle? And that seems to be the conversation week in and week out. We did a synopsis trade. I don't know if last show we went through, we did an actual time spread. They're going to be announcing here on December 10th. I don't mind just getting long synopsis. I want to trade the options, but the options are just too wide. It's an expensive underlying, and the options marketplace just isn't liquid enough. It does not have the open interest that we really need to be able to trade it. We did a diagonal spread, and that trade worked out. But I don't think I want to do another one going forward, but I don't mind owning some synopsis. Now, you could sell a put spread because you need to get into the trade. And if you're correct on your forecast, it just expires worthless. That's one way to get bullish. But then again, if it doesn't on the downside, then you're forced, you're losing on the trade to deal with wide bid-ask spreads. So that's always an issue. So I'm just going to go and look at the VIX index, and I'm going to talk about buying a deep in the money call option. And I'm kind of building a portfolio of deep in the money call options. And the trade, the underlying stock that I want to look into going into the holidays is Amazon. Amazon Web Services is their main driver of revenue, but they do obviously have a big piece in the retail marketplace as far as the toys, as far as Christmas presents are concerned. So here we go. December 17th. Let's run to the Tradier Pro software. And I want to get short on the VIX going into this December 17th expiration. This is a derived value for the VIX, which means that it's not always 100% accurate, especially in the VIX index, because it's such a weird product. But that is about where the market is at. Looking at a real-time quote in the VIX, it's right around 15.5. So what I'm assuming that the market is going to stay calm over the next 12 or so days. We have earnings, but we're at the tail end of the earnings season, and we're not really into the retail season. I expect the markets to drift higher through this period and the VIX to kind of stay where it's at. You never know, especially in these times, news items can always hit the market, especially with what's going on in Washington. So you can always be blindsided by some type of news. But with the futures contract going out 12 days, the way that we always figure out the future is we just want to look at where do the call and the put line up. The call is trading at $1 right here at 17.5, and so is the put. So it's, if anything, the call's a little bit less. So it's probably just a smidge below the 17.5 on this instance. And I'm going to look to sell that 17.5, and I'm going to buy the 20.5. So here's the trade. I'm going to buy one. And so very rare. I mean, it's not that often that I do want to do VIX trades and be bearish on the VIX. I like to do it when we have the big upside potential, where like heading into October, if you've watched a lot of Options Guy TV, we've done a lot of VIX trades that have done, actually better than most going into October. This year wasn't as volatile, but the trades still did okay just because of the way we set them up. And then we're going to sell 2 of these and stop short on 1 of these. All right. Oh, not quite $2. That means we're break even below 16.5. Let's send it to the what if calculator. And maybe we adjust it a little bit, but it brought it in at about $2.97. So if we do this trade, I think we're going to go down 1. If we got the actual VIX index at 16.5, I think we might go down to 19.5 if we have them. But if the market stays below the 15.5 level, right here where our strike is on the our 16.5 level, we just break even on the trade. If the market drifts higher and goes to the middle strike, which is 17.5, this thing can trade for as much as $3, and we put it on for $2. That means that we make $1 on the trade. Now, on the way down, we're on the way up here, our risk kicks in. If we finish on the 17th at 20.50 in this scenario. So I want to adjust it and bring it back down a little bit. What I really want is to be able to at least make a quarter if we go below the 16.5 level. So maybe we need to bring that down to 16, and we'll see if we can get that done with the markets the way they are. So let's clear this out. Let's go down to the 19.5. Maybe we pay up a little bit more. Let's try this one. 290. Then we only make a dime, but then we got $3 worth of risk. Yeah. I'm just going to move it down. Here we go. Let's go 20. Let's go down to 17. Sell 2 of these. And stop at 16. 194. Ugh. 19. All right. Gonna make me do the 19s, huh? 19, 17, and stop at 16. Sell 2 of the 17s and stop at 16. No. The market's just not. I'm not liking what I'm seeing here with the market open. Looked at it just the other day, and the trade worked well that I was exploring with Lex on the show, but I don't like the trade here. So let's do December or next one out. Where are we going? All the way out to January and through the holidays. We need a much better risk reward, though. Let's look where the January futures are at. In general, I do expect the markets just to drift higher, and I expect the VIX to, just kind of calm a little bit. Let's see where we got I don't like the 17-day. I think with 12 days remaining, we just don't got enough upside if the market continues down below the lowest strike in our trade. I guess the alternative would be to look at this and go markets at 17.5, sell at the money premium and buy the out. That's 30 cents, 4 points wide. Let's look at this one. 38 cents. Ugh. Wanted that to be 50 cents. It's just not. Where's the VVIX right now? 91. Okay, so the VVIX is the VIX of the VIX. And if I chart it, we're kind of in the lower end of the range, which is making these trades a little bit tough. VVIX. So, yeah, we're at the bottom of the range. So this is the VIX of the VIX. So this is using VIX options to calculate a VIX. And ideally, we're really dropping off. Look at precipitously dropping off to the downside here. We're down at the lower way. I guess right here is about 82. So that's about the lowest it gets. But when we get to this level, we're at the way low end of the range, 86, and we came down, and now we're sitting at 91 vol. Obviously, the 200-day is right here, hanging out at about 102. The 20-day is up at around 107. So, yeah, we've really dropped off precipitously on the vol. Now, this is 30-day. So, It doesn't necessarily apply to the nearest term, but it has it obviously has an effect. It's worth looking at, and that's probably why these two trades just don't have enough volatility premium to make them interesting. So let's go out. Let's look at the January, which is 47 days away. I don't want to look at the W's because those are the weekly options, and I don't like the markets in them, the VIXW. So I usually like to just trade the monthly, and let's see if this is around 19 and a half. Yeah, not bad. So the market on the futures contract, we are buying this one. If we sell this one, 29 cents debit. Okay, so this would be 19.29. So that is that's about where the future is going out to January. Well, I don't mind that. And let's see what happens if we go and sell that one. Okay, let's sell two of these. Let's clear it up. Okay. So 19, 3 is 22. We're going to buy the 22s, sell two of the 19s on the bid, 1, 2, and then stop short on the 18. 168. 32 cents on the downside. And we got I don't mind it. Let's make it an official paper trade. We're going to be watching it longer than I'd like to. I just would rather be able to put on this trade and then come back to it a little bit sooner. But in this instance, we are, and the P&L calculator isn't really displaying it well. Let's try that again. Yeah. Well, okay. So this is an open wing butterfly to the downside. We have 3 points from, I'm looking at the bottom of the screen, from 22 down to 19. That's 3 points wide. That's the maximum that it can trade for if it went out right at 19. That's 3 points wide. We stopped short on our short spread of our open wing butterfly, and we have $1 there. So the maximum that it can trade for below 18 is $2, or it's $2. We're paying 130 for it. Well, now it's 170. I like the 130. Let's call it 150. That's where my goal would be. Why did it just jump so much on me? And then we can make around 50 cents. Right now it's saying 30 cents at 169. Oh, I think we're froze. 22.18. Well, let's say we want to sell that. Now we're moving. Let's put it in at 160. That's kind of be my goal, because then anywhere below 18 we can make 40 cents. Our risk is 160. We can make 40. On the upside, we would make 140 if it would finish right at 19. And the P&L nothing seems to be working on this trade. Okay, but this is going to be the paper trade. This is the official paper trade. I'd rather do the January 21s. I expect the markets to just meander higher into the end of the year. We do have the Fed meeting, and it's all going to be about the conference call afterwards. Right now, there is about a 90% chance that they're going to cut at least 1/4 of a point. It's more about what's going to happen going into the future and the conversation about it. So I think it's already baked into the market, and I think that's part of the reason why we've had a fairly strong market here. But we also have seen good news on the retail side of things. Overall, after the earnings report, we've had good reports about the consumer. Walmart is one of the companies. Target is struggling a little bit, is one of the companies that's struggling. But as far as everybody is mentioning on the consumer side of things, things have been a little bit strong. So, or have been okay, not strong, but have been okay. So now let's go out and that leads right into Amazon. And I want to do a paper trade at Amazon. And I want to continue with the buying deep into money call options. We've done it on a few of the underlyings over the past couple of shows. But as an alternative to buying 100 shares of stock, which would be $22,974 plus any fees to get in, $22,974 if you bought 100 shares. We're going to go out to the June expiration, and we're going to buy a deep in the money call option on Amazon. And here is the April, May, June, 195 days out, June 18th. Scroll down to the 80 right here, 195. We buy this. And now our total cost will be $4,795 if we pay the ask for it. We got a decent market, and you never have great markets on deep in the money options, but you have decent markets. This is 30 cents wide. We'll say it's always hard if you're buying an individual option to trade in the middle of it. So we're going to say 47.85. So if we execute at 47.85, just above the bid, that's $4,785. $4,785 divided by 22,984 equals, we're putting up about 20% of the price of Amazon. So in other words, is it possible to buy 100 shares of Amazon and lose 20% on your 100 shares? Yeah, it's very possible, right? It's volatile underlying. It's in the news all the time, one of the Mag 7. And if we look at it, if you like Amazon, if you own some Amazon and you want to get a little bit longer, this to me is a way to double up, if you would like, without putting all the risk on it. So I personally own Amazon, and what I have done, because I actually had, and I've mentioned this a couple of times on the show, that I really was expecting a downturn in October. We didn't get it. So I'm like, all right, I don't want the cheese anymore. Just let me out of the trap. And I've gone in and used that cash that I had on the sideline and have bought some deep in the money call options. And I'm sharing that with you because that's what we've kind of been doing on the show, finding underlyings that we want to trade in and different sectors in the marketplace. So this is one of the underlyings that I own in a different portfolio, and I've gone in and actually bought some deep in the money calls. This is the 195 strike. Paying that, you're down. The maximum you could lose would be 20% if you think about it as buying 100 shares of stock. If you were going to buy 100 shares of stock, it would cost you $22,900 approximately. So I always look at it relative to that. We're buying an 80 delta call option. We're paying $4,785 is where we had it at. That's where our limit price was at. And then also I look at it as, well, I don't want to lose 20%, right? I could lose 20%, but that's the maximum. And I could easily lose that just by owning the stock. There's been more than one time that Amazon has had a 20% drawdown. It hasn't happened any time in the recent future. I don't think it has. Let's go look actually real quick. But yeah, we came from 258 all the way down and touched right on that 200-day moving average. Let's see how much. I'm just more curious than anything what that drop down was. High 258, low 212. So we're 258 to, we'll say 40.48. 48 divided by 258. Yeah, that's about 20%. Okay, so if I mean, that's the general movement of the underlying stock. And then we also have seen this type of move here, this one here. I don't want to lose 20%, and I'm not going to let myself lose that. So my rule has always been that if I buy the deep in the money call option, if this comes down to my strike, and this is the way that I've always kind of judged it, if this comes down to my strike, the 195 strike, I always want to sell the most at the money option contract. So if you look at where the most at the money is at right now, we'll call it $26. If the market instantly went to 195, it would be probably worth a little bit more than that because vol would increase. But in that instance, this should be trading about where that's at, right? So that would make that an at the money option contract, and you'd be down about half. If it hits my long strike, I get out. Now, if you cut the time in half, let's go down from 200 days over here down to about 100 days, and still look at the most at the money option contract. So that would be about the March contract. Now you're talking about $18, right? So you're still saying that if it ever comes down and hits the strike, I'm just going to sell it and get out. Now, you could also just say that if it gets cut in half, I'm going to sell it and get out. But just be cognizant that it probably needs to come all the way down to your strike for it to get cut in half. Okay, so if you want me to go through that one more time, the June 18th expiration, 195 days. We're buying this as a stock substitute. Market's trading at 47.85. We're buying the 195 strike call option. We look over at the delta. That's got an 80 delta. That means that if the underlying stock goes up 1, this option contract should make $80. It's a substitute to buying 100 shares. So I like to think of it as 80 shares. Instead of buying 100 shares, I'm buying 80 shares in that instance. Now, the other benefit of buying the deep in the money call is that if it does go up, I actually pick up shares. Why? Because I pick up delta. So if I go deeper and deeper in the money, the delta is going to increase. If it starts coming down and I become more and more like an at the money option contract, the delta actually decreases. So on the upside, I gain shares. If I'm losing on the trade, I lose shares. If you think of delta as the number of shares that the contract represents. So I like this as an alternative to buying it outright. I still own the stock. I very rarely just buy options on an underlying that I like, that I have a longer term view at. Obviously, I'm not going out more than 195 days because this is the expiration date. But I do like this position. Another little tidbit that I like to do with buying the 195 calls is that if this delta does become 1, okay, let's come on. This delta does become 1, we're quite a bit more in the money. So the delta down here is 105 strike. We're going all the way down to the 105 strike before we get close to a 1 delta. But if that does happen, then I want to roll back down to an 80. I want to take some profit and roll back down to an 80 delta, and keep the same dynamics of the option contract in place. But this is one way to think that, I want to remind myself that it's an option, and I still need to take my profits, and it's okay to, if I'm still bullish, to go back in and trade it again. And that would be my approach on it. All right. The VIX trade didn't work out very well. It looked good just the other day. Oh, okay. I got a couple questions. All right, let's go ahead and throw a couple up. Do you think the holiday volume is making the calculation less dependable? No, not the calculation on the futures. You can see if that's what we're looking for on the futures contract. What I do think is that the volatility, the VVIX, coming down. It was a little bit higher just the other day, and that smidgen and drop in volatility is not making the near-term option open wing butterfly look interesting. That simple. Yeah, on the VIX trade. Yep. And it makes the calculation okay, but it's the fact that the volatility on the option contracts has gone down. So the implied volatility of the actual options if we had the VVIX or just the volatility in general a little bit higher, and you can't really trust the numbers because it's the future. So I'm not looking at this number here like I would on Amazon, right? This is the vol for that Amazon right now. I'm not going to look at that because that doesn't work on the VIX because you have a futures contract, and so the calculation is using the spot, and it's not going to make the balls right. So yeah, the volatility came down. That's simple. Any other questions? We're at time. I've gone in and I've in my own personal account, I put on 4 deep in the money option contracts. I did Nvidia. I did Larry Ellison's company. And I also went in and I did have a position on in Goldman Sachs, but I did that a little while ago. And those are my 4 new positions that I put in with some of the fodder that I had. Oh, and UNH, and I bought UNH outright. I didn't buy a deep in the money call option, and I've been talking about that. We did a lot of trades on United Healthcare. Stock is down. It's actually interesting again to me. A lot of insider buy-in. Warren Buffett jumped in and did some things. But it's back down into the middle of that gap. Actually, let's go down to 300 days. So the stock has came down all the way back down to the bottom of this gap that when we were doing our option trades, we were looking for that gap to fill, and it did. And so we almost filled here, came up and we filled it. Now my eyes are over here, right? And we touched that. And then we failed. We had a breakout and failure at this level. So that was not a good sign. And the market rewarded it to the downside. And now we're back in this range. So like I personally am kind of flat on the stock, but we did really well with our butterflies through here. Now we're really consolidating, hanging one. I mean, how many times we're just completely bouncing off the 20-day moving average, need to break out above the 50 to get back to the 200. But it's not it's a good underlying. It's got solid markets, maybe lean getting bullish into the end of the year with United Healthcare. Go back and do our open wing butterflies. Maybe we'll do that on Monday. I don't mind that at all, right where this is at. I do think I am longer term bullish on this underlying. Go back to, let's do 2,000 days. And, healthcare just, it's tough in that it's the one of the sectors that AI can really help out, extremely help out, because obviously just records in general in the hospitals and the ability to talk amongst yourself, switching doctors, all these different things, AI can really help with. And United Healthcare is too big to fail, even though they've had some problems with cooking the books. They'll get that straightened out. The insiders that are buying the underlying stock kind of hint that would more than likely happen. But you see this type of upside, and Warren Buffett's in it too. Berkshire Hathaway. So I like it. I think this is one of the stocks you can bottom fish, but since we came back and filled the bottom and we're seeing a little bit of support, I wouldn't mind actually doing another one of our butterflies to the upside and see if we can fill the gap going into the end of the year. All right, everybody, a little bit long. Sorry, I started a little bit late, but I was struggling with that VIX trade. I just couldn't find the one that I wanted. I thought that the near-term one was going to pan out a little bit, but no, it didn't. Sorry about that. Not a big fan of that VIX trade. I'd have to go all the way out to January to make it interesting. Definitely don't like the December 17th expiration. Thanks for stopping in, and we'll see you Monday to probably look at an open wing butterfly in United Healthcare. and I'll look at a couple of other underlyings, and I'll add another deep in the money call option. I'll find another underlying that I don't mind trading. Thanks for stopping in.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.